let's talk how to maximize and protect your returns. And there are, for you as a beginner, as an amateur, there are only two rules, and that's compounding and diversification. We talked about compounding already many times in this course. That's the concept of the magic penny. When over the long time, if you multiply it a bit by bit, year after year, you get tremendous results. So I won't repeat myself. You can see it in the other parts. You need the compounding. You need the patience and the time. And the second one is diversification. And diversification, that means spreading your investments across variety of different assets and or different things. It's like that old saying that don't put all your eggs into one basket. So even if you would fall, you still have the other basket. The same here. If you diversify somehow and one thing goes down, maybe the other thing would go up and they would balance each other out, and you won't have that psychological pressure of a drawdown in your investment, in your account. And anything that helps you to sleep at night, anything that helps you to stay with your strategy is a best strategy for you. If you cannot sleep at night, this means that you are taking too risky investments. That means that you are not diversifying enough. You would need to diversify across assets, across time, and across markets. First of all, diversification across the assets. So you'll have basically those three big asset categories that we spoke about. Debts or loans or bonds, stocks, and real estate. And I'm saying that you need something from all of those. And if the stock market would be down, maybe the real estate will go up, or at least from the real estate you will get some yield, or from the bonds you will get some yield, returning something you back. So psychologically you won't feel that everything is going down. And waiting through the drawdowns is very important. Having patience, constructing everything so that you can wait it through. If you are not waiting through the drawdowns and you cannot sleep, I'm saying you are not diversifying enough. So next one is diversification across the time. And as I spoke before, basically you cannot time the market. And all the biggest internet broker websites, in generally all the stock market brokers, they are saying that retail customers, 80 to 90% of retail customers lose money over time in the stock market, despite that stock market in general is going up over the time. So what happens? They are trying to time the market, and they are timing it, especially the majority of the retail customers, they are timing it just on the wrong moment. And the solution over here is so-called the dollar cost averaging, which is the market is, like in this example, for example, the market is going up, you are buying. The market is on a local peak. You don't know that it's a local peak, but you are still buying. The market is going down, you are buying. The market is on the bottom, everybody is in fear, you are buying. Basically, you are just buying on the same frequency every month. Put it on like auto invest feature if you have such one in your bank app, in your neobank, or you get your salary, you put aside $100 to $200 and you invest that in the stock market. Wherever it's going down or up, it's on the bottom, on the peak. It doesn't matter what you think. It doesn't matter what the Bloomberg or any other CNBC finance television says. You are just so-called dollar cost averaging it over those 50 years that you would have your active working or income career until your retirement. You basically just don't care. You should avoid trying to time the market, because as I said, 90% of the people cannot time the market. Next one is diversifying across the markets. And especially when we speak about the stocks part of the assets, it's very hard to say that, for example, pick some stocks and say that, I think that Apple would be better than Microsoft over the next 10 years, and I'm buying Apple. It's an active bet saying that Apple would be better than Microsoft. I don't know if this would be true or not. If you know, it's fine, but I'm saying it's nearly impossible to know. It's an active bet. And what if I don't want to make a bet of Apple against Microsoft? What if I would say that I'm happy of all the technology stocks? Myself, as a former IT guy, I would trust in technology and would say all the IT stocks are good, okay? But again, it's an active bet. If I would invest only in IT stocks, it's an active bet that is saying that technology stocks over the next year maybe would be better than financial stocks or healthcare stocks. It's again an active bet. And I would ask myself, well, I'm not sure of that. I'm sure that technology over 100 years would be better than maybe the finance sector, I hope, as a former IT guy. But indeed, I don't know. So, and it's again an active bet, betting on technology. So can I bet on stock market as a whole, on, for example, all America as a country, as a capitalism as such within that country? Yes, you can do that. But again, it's an active bet. Are you sure that America would perform better than emerging world? And if I would say, well, again, it's an active bet, I'm not sure. Can I bet on all the companies within all the world? Yes, you can do that. And that's basically only one active bet, that you are saying that all the stocks in all the world over the time, they would try to go up to the right. And that's the only bet. You diversify across the markets totally. So in that case, you would need to buy one stock of all the companies in all the world. And that would take a lot of money and a lot of time. And to make such a salad by yourself will cost you a lot. And biggest investment funds in the world, they are doing it by themselves. The biggest governments in the world probably are doing it by themselves. But solution for you is next things that I will talk about are the ETFs. And ETFs are exchange traded funds. So fund is just a collection of stocks that is already pre-mixed and sold within the market. You can imagine it as a various stock salad or a cocktail. And it's I'm just showing you the biggest ones and what they are made from. So, for example, the ticker is the letters that you enter in the stock trading program, or just how you identify those various ETFs or even the stocks. For example, Microsoft has its own ticker, Apple has its own ticker. In the Apple case, it would be AAPL. And so ETFs have their own tickers. So the ticker is the most simple way to identify which exchange traded fund we are talking about. So for example, ETF VT is the fund made of all the stocks in all the world. Another one is VIA. That's all developed market stocks. Basically, it's North America plus Europe plus Japan plus Australia plus some highly developed Asia and some other markets. Then there's if you want to make a little bit more active bet, then you can go for VMO. That's all emerging markets all together, cocktail of all the stocks over there. Or the most popular one is the SPY, or the so-called SPIDER. That's the top 500 US stocks. They already prepackaged into a fund, and you don't need to buy those 500 stocks by your own. You buy just one, let's say a stock or one small fraction of that fund that inside has all this mixture. And also there's, if again you want to make some active bets, QQQ, and that's the top US technology stocks. That's the Nasdaq, so-called the Nasdaq market. For you as for beginner, again, as I said, you cannot time the market, and probably neither you can make a good active bet just picking one particular stock or a couple of the good companies. I would recommend you buying and investing into these blends, these ETFs.